My name is David Jaffe. Welcome to the Wealth and Health Podcast, where you'll learn valuable skills and positive habits that will improve your life. This podcast originally aired as a video on my YouTube channel at youtube.com/beststockstrategy. The Wealth and Health Podcast is brought to you by beststockstrategy.com.
The double dip money glitch, 5% yield plus trading gains. Discover how sophisticated traders earn risk-free interest while maintaining full trading power on the same capital, a strategy institutional investors have used for decades. The problem, the inflation trap. Your cash is quietly losing value every single day. While most retail traders focus on their next trade, their buying power sits idle in standard brokerage accounts, earning virtually nothing. Meanwhile, inflation relentlessly erodes purchasing power at 3 to 4% annually. You're working hard to generate returns, but your uninvested cash is working against you. The opportunity cost is staggering. On $100,000 of idle cash, you're losing $3,000 to $4,000 in real value each year before you even place a trade. 3.4% annual inflation is eroding your cash value, but the bank is only paying you 0.01%. The solution: treasury ETFs that pay you to wait. SGOV iShares, which is 0 to 3 month treasury bond ETF. It pays monthly dividends of approximately 4% annually. It trades like a stock with T+1 settlement. Income tax is ordinary income, but maximum liquidity and simplicity. Look at this. I like how they misspell treasury here. Box. Alpha Architect 1 to 3 month box ETF. Accumulates value through price appreciation rather than dividends. Returns taxed as 60% long-term, 40% short-term capital gains, regardless of holding period. Superior tax treatment for higher earners. Both vehicles earn the risk-free rate, the same rate the Federal Reserve pays on reserves. You're essentially getting paid what banks get paid, without the credit risk. What is yield stacking? It's a double dip. Yield stacking is the practice of earning interest income while simultaneously maintaining full trading flexibility on that same capital. It's how institutional traders operate. Money never sits completely idle. The traditional approach: cash earns 0.01% in brokerage sweep. You must choose: earn interest or trade. Opportunity cost compounds daily. The yield stacking approach: capital earns 4% risk-free rate. Same capital available as margin collateral. Both income streams working simultaneously. Professional traders and hedge funds never let cash sleep. They understand that capital efficiency, extracting maximum value from every dollar, is a competitive advantage that compounds over time. Key concept: the margin secret. Here's where the magic happens. In a margin account, SGOV and BOX are treated as marginable securities, not cash. This seemingly technical distinction unlocks powerful capabilities. You purchase a treasury ETF. Your $100,000 is now in SGOV or BOX, earning 4% annually through dividends or appreciation. The broker assigns collateral value. Your broker assigns a loan value, typically 90% for these ultra-safe treasury ETFs. Your $100,000 position provides $90,000 in margin buying power. You trade with margin power. You can now execute trades using that $90,000 margin capacity while continuing to collect the 4% yield on your position. This is stacking returns on returns without tying up your buying power. The result, you're earning the risk-free rate on your capital and maintaining the ability to deploy that capital into trading opportunities. The same dollar is working twice. The strategy setup, your allocation framework, 90% treasury ETFs, SGOV, or box position. Why this split works. The 90-10 allocation ensures you maximum yield while maintaining a cash cushion for any margin interest charges or small fees. Your 90% position in treasury ETFs generates steady income while serving as collateral. The 10% cash buffer prevents forced liquidations from minor account fluctuations. Think of this as your war chest, capital that's earning income while staying ready for deployment. The tax efficiency hack. SGOV tax treatment. Monthly dividend payments provide consistent cash flow, but are taxed as ordinary income at your marginal rate. For traders in high tax brackets, this means giving up a significant portion to taxes. Best for lower tax brackets, those needing monthly income or tax advantage accounts like IRAs. For box, price appreciation via option strategies that qualify for Section 1256 tax treatment in the United States. That means that 60% is taxed at long-term capital gain rates, which has a 20% max tax rate, and 40% at short-term rates, regardless of your holding period. This is best for high earners in taxable accounts who want to keep more of their 4% returns. This can save you 10 to 15% on taxes annually. Tax efficiency matters enormously over time. On 100,000 earning 4%, the difference between ordinary income and 60/40 treatment can save $600 to $800 annually, money that compounds in your favor. The umbrella hedge strategy. Your 4% yield provides built-in budget for portfolio insurance. You can allocate a small portion, perhaps 0.5% to 1% annually, to protective option strategies. The mechanics. Purchase long-dated put spreads on broad market indices like SPX or XSP. These are your crash insurance contracts that gain value during severe market pullbacks. You're essentially using a fraction of your risk-free income to buy protection against tail risk events. When everyone else is panicking during a crash, you'll have hedges that pay out precisely when you need liquidity the most. Put spread setup. You'll buy 6 to 12 month put spreads, 10 to 15% below the current market levels. This will cost about 1% of the yield, protection which will be funded by your treasury interest income, and then these long put options will act as hedges and they'll pay off exactly when the opportunities emerge during a market crash. Tactical rules. The golden rules of strategic cash management. SGOV is for peacetime. During normal market conditions, your capital sits in treasury ETFs, collecting the risk-free rate and maintaining margin capacity. You're patient, earning steady returns while waiting for genuine opportunities. Cash is for wartime. During market crashes, dislocations, or exceptional opportunities, you must be ruthless about converting your treasury positions to cash. The 4% yield is meaningless compared to buying great assets at 30 to 50% discounts. Mental flexibility is everything. You cannot become emotionally attached to your treasury positions. These ETFs are a holding pattern, not a destination. When opportunity strikes, and it will, you need the discipline to liquidate immediately and deploy capital aggressively. The action plan, your implementation protocol. Audit your cash today. Calculate exactly how much buying power is sitting idle, earning nothing. Include your brokerage sweep accounts and any dry powder waiting for trades. Choose your vehicle. High tax bracket and taxable account? Choose box. Lower tax bracket or need monthly income? Choose SGOV. Either choice beats inflation and bank rates. Execute the 90-10 split. Move 90% into your chosen treasury ETF. Maintain 10% as true cash for margin interest and fees. Set calendar reminders to review allocation quarterly. Monitor and stay ready. Check margin utilization weekly. When opportunities emerge, be prepared to liquidate your treasury position instantly and deploy capital where it matters most. The bottom line: stop letting inflation steal from your trading capital. Implement yield stacking today and start earning the institutional advantage. 4% risk-free returns while maintaining full trading flexibility. Your future self will thank you. If you have any questions, leave a comment below. Please hit the hype button. You can hype this video. That's the easiest way to help me and to show appreciation for me sharing this valuable information with you. You can also visit beststockstrategy.com, enter in your email address, and receive over $400 of valuable free training.
Visit beststockstrategy.com and submit your email address to receive valuable free training. Please give this podcast a positive rating and a review. If you have any questions, visit beststockstrategy.com and send me a message.